For years, the world of dividend investing often felt like navigating a stark choice. Do you chase high yield from mature, sometimes stagnant companies, or do you sacrifice immediate income for the explosive growth potential of innovative, often dividend-light sectors? It was a persistent dilemma, forcing investors to pick a lane, constantly weighing consistent cash flow against aggressive capital appreciation. What if I told you that fundamental trade-off, that age-old dividend versus growth philosophy, is now being radically redefined? What if you could genuinely pursue a total return dividend strategy that transcends these conventional boundaries? Get ready to challenge everything you thought you knew. Enter two exchange-traded funds, or ETFs, that at first glance appear to be strange bedfellows from completely different corners of the investment universe. The J.P. Morgan Equity Premium Income ETF, or JEPI, and the Invesco NASDAQ 100 QQQ Trust Series 1, better known as QQQM. One is a high-income generator engineered for consistent distributions, the other a high-growth powerhouse synonymous with technological advancement. But together, this unexpected duo isn't just a powerful combination, it's a paradigm shift, capable of redefining income generation and portfolio resilience for the modern investor. Our bold claim is this: the strategic pairing of JP and QQQM offers a groundbreaking approach that blends immediate, consistent income with aggressive long-term capital appreciation in ways previously unimaginable for the average retail investor. This isn't just about diversification, it's about pioneering a comprehensive strategy that bridges the gap between consistent cash flow and robust wealth accumulation. This powerful synergy fundamentally dismantles the traditional dividend or growth question, instead presenting a compelling dividend and growth solution that can elevate your portfolio's potential. Before we continue, we did like to encourage you to kindly subscribe to this channel, like and share the video so that others will see it. It helps motivate us to keep creating informative videos like this based on our experience. Thank you. Let's briefly outline their individual strengths. First, JP. This is not your typical passive income fund, simply holding dividend stocks. JP is an actively managed ETF specifically designed to generate a robust monthly income stream while aiming for lower volatility than the broader equity market. Its core strategy revolves around selling covered call options on a diversified portfolio of large-cap U.S. equities. This sophisticated approach allows it to collect premiums from these options, which are then distributed to shareholders as income. It's about creating income through intelligent option strategies, rather than solely relying on the underlying dividends of its holdings, offering a consistent payout even when traditional dividend yields might disappoint. Then we have QQQM. Where JP actively engineers income, QQQM operates on a completely different philosophy. It's a passive, growth-driven ETF that tracks the NASDAQ 100 index, providing focused exposure to the largest 100 non-financial companies listed on the NASDAQ stock market. Think technology giants, innovative disruptors, and the engines of future economic expansion. QQQM's role in a portfolio is not about income distribution, but about capturing the upward trajectory and capital appreciation of these market leaders. Its value grows as these companies grow, reflecting the collective innovation and market dominance of the tech-heavy index. The fundamental difference lies in their wealth creation mechanisms. One constructs income through options, the other captures wealth through market cap-weighted share price appreciation. The immediate synergy here is profound. Imagine a portfolio benefiting from JP's reliable, volatility-tempering monthly income stream, which can act as a financial cushion or be reinvested, combined with QQQM's potent, growth-oriented exposure to the cutting edge of global innovation.
This strategic pairing creates a balanced, adaptable investment vehicle that can thrive across diverse market conditions. It provides a foundational income layer while still participating vigorously in the market's most dynamic growth sectors. This combination elegantly solves the long-standing investment dilemma, offering a pathway to both stability and substantial upside. As we delve deeper into this tutorial, you'll gain a comprehensive understanding of how this powerful duo truly operates. We'll meticulously unpack their intricate mechanics, dissect their historical performance across various economic cycles, and candidly discuss the inherent risks associated with each. We'll explore the crucial tax implications you need to consider for both JEPI and QQQM, and most importantly, we'll provide practical, actionable strategies for seamlessly integrating these ETFs into your own portfolio construction. This isn't just an overview, it's your definitive guide to harnessing their combined potential. Now, a bold claim like JEPI and QQQM just changed dividend investing forever undoubtedly warrants a realistic perspective. No single investment strategy is a silver bullet, and market dynamics will always present challenges. However, what this strategic combination represents is a profound evolution in how individual investors can approach income generation and growth simultaneously. It's an innovative approach that offers a robust framework for financial resilience and significant growth potential, truly pushing the boundaries of traditional income-focused investing and challenging us all to rethink what's truly possible in our portfolios.
Do you find this video valuable? Kindly like and share the video so that other investors will get to see it. Also subscribe so you don't miss any of our valuable investment informations. Comment where you're watching from so we tailor our next video to your interest. With that forward-looking perspective in mind, let's truly deconstruct the two titans at the heart of our discussion, JEPI and QQQM. Understanding their individual mechanisms is paramount to appreciating their combined power. Before we continue, it's obvious you're getting value from this value-packed video. What don't you kindly share and like the video to help other investors see this video? Also, tell us where you are watching from. First, we dissect JEPI, the JP Morgan Equity Premium Income ETF, an actively managed fund with one primary objective: consistent high current income and lower volatility than the broader equity market. Unlike many passive index funds, JEPI's managers actively decide its holdings, a blend of S&P 500 stocks and equity-linked notes, or ELNs. Income generation primarily stems from a sophisticated covered call strategy. JEPI holds stocks, then sells call options on some, receiving an immediate premium. This premium is JEPI's main cash flow, directly fueling its robust monthly distributions. The inherent trade-off, selling these calls, caps potential capital appreciation during strong bull markets. If a stock skyrockets past the call strike, JEPI may be forced to sell at the lower strike, missing further gains. This mechanism prioritizes income generation over capital growth, a crucial distinction. JEPI's income engine isn't just traditional covered calls. A significant portion of its yield enhancement comes from innovative use of equity-linked notes. An ELN is a customized debt instrument issued by an investment bank whose returns link to underlying equity performance. JEPI invests in these ELNs, tailored to provide additional income through embedded derivative strategies. Benefits: customization and income boost. However, ELNs introduce specific risks. Counterparty credit risk: if the issuing bank defaults, JEPI could lose its investment. Second, ELNs can be less liquid, meaning harder to sell quickly without impacting price, particularly in volatile markets. This sophisticated layer truly sets JEPI apart. JEPI's historical performance highlights its objective: remarkably consistent monthly distributions. Its covered call overlay and active management generally lead to lower volatility versus broader market indices, offering a smoother ride.
While total return might lag during exuberant bull markets due to capped upside, its performance tends to be more resilient during sideways or moderately bearish conditions, cushioning downturns and providing a vital income stream. Consider subscribing to our channel, like and share it with your friends, and comment the key thing you learned so far. Now let's pivot to QQQM, the Invesco NASDAQ 100 ETF, a stark contrast. QQQM is a passively managed fund designed for pure capital appreciation, tracking the NASDAQ 100 index. This index is synonymous with innovation, comprising the 100 largest non-financial companies listed on the NASDAQ. Technology giants, innovative healthcare, fast-growing consumer discretionary, businesses focused on expanding market share and reinvesting profits, not large dividends. You might know its older sibling, QQQ. QQQM was launched to offer individual investors more accessible and efficient NASDAQ 100 exposure. QQQM's key advantages over QQQ, typically a lower share price, making it easier to buy in smaller increments, and a slightly lower expense ratio. However, acknowledge the NASDAQ 100's inherent concentration risk. It's heavily weighted towards dominant technology companies, susceptible to sector downturns. While QQQM offers minimal direct dividends, its substantial capital appreciation can be strategically utilized as growth dividends. This involves periodically selling a small, calculated portion of your appreciated QQQM shares to generate cash flow, effectively creating your own dividend stream from growth. This approach provides immense flexibility, allowing investors to decide when and how much income to generate, rather than being beholden to fixed dividend schedules. Let's connect these disparate philosophies. Imagine JEPI's stable high income and lower beta acting as a robust ballast, cushioning QQQM's inherently higher volatility. This powerful complementarity is where the magic happens. Combining these two ETFs isn't just diversification, it's about leveraging their distinct strategies to potentially enhance risk-adjusted returns. Metrics like the Sharpe ratio, return per unit of risk, or the Sortino ratio, focusing on downside risk, often show significant improvement when JEPI and QQQM are held together. JEPI provides consistent income and downside protection, while QQQM offers aggressive capital growth. Their low correlation further strengthens this portfolio, as one tends to perform well when the other might lag, leading to a smoother overall equity curve and greater maximum drawdown resilience. Finally, it's vital to touch upon initial tax considerations. JEPI's distributions aren't always straightforward qualified dividends. A significant portion can often be classified as return of capital, which generally reduces your cost basis and isn't taxed until you sell, or potentially taxed at ordinary income rates. QQQM, on the other hand, primarily generates capital gains when you sell appreciated shares. Understanding these distinctions is critical for tax efficiency and sets the foundation for a deeper dive into optimizing after-tax returns. Now that we've truly explored tax considerations, let's put JEPI and QQQM into action, mastering this powerful hybrid approach. Your ideal blend depends on goals, risk tolerance, and life stage. For income, consider 70% JEPI, 30% QQQM. For growth, reverse it. A balanced 50-50 split offers both. Align allocation with financial objectives. Maintain your allocation through consistent rebalancing. Annual or semi-annual rebalancing works well on set dates. A dynamic, threshold-based approach, rebalancing when allocations drift by, say, 5%, helps manage risk and prevents overtrading, optimizing long-term performance steadily.
With JPI's monthly dividends, you have compelling choices. Reinvest into more JPI for compounding income, direct them into QQQM to supercharge growth, or utilize them as direct cash flow for living expenses. Each choice significantly shapes your portfolio's trajectory. Who benefits most? Retirees find JPI's high monthly income crucial for cash flow and inflation protection. QQQM offers vital capital growth to help capital keep pace. It's a resilient income plus growth solution for a multi-decade retirement. Young accumulators might favor higher QQQM for growth, with JPI providing stable income for reinvestment. Balanced investors, seeking both, can opt for a 50-50 or similar allocation, balancing strong income generation with QQQM's market-leading innovation and growth. Find your personal equilibrium. Crucially, JPI's return of capital (ROC) distributions reduce your cost basis, deferring taxes until you sell, potentially increasing capital gains then. QQQM's qualified dividends are taxed at preferential long-term capital gains rates. Selling appreciated QQQM shares triggers capital gains tax. This complex interplay demands incredibly strategic tax planning. Utilize tax-advantaged accounts wisely. Holding JPI in a Roth IRA avoids future taxes and ROC complexities entirely. In a traditional IRA, taxes defer until retirement. QQQM thrives in a Roth for tax-free growth. In taxable accounts, consider tax loss harvesting strategically. Combining these ETFs introduces specific portfolio-level risks. High inflation significantly erodes JPI's income purchasing power. QQQM's tech concentration faces substantial headwinds during prolonged tech downturns. Both are exposed to overall market cyclicality. A deep recession impacts income stability and growth potential. While powerful, the JPI QQQM combination isn't your entire portfolio. Complement it with other ETFs for broader diversification. JEPQ, focusing on NASDAQ 100, offers tech-centric income. DIVO provides dividend growth with covered calls. For broader market exposure, consider VOO or SPY. Holistic thinking truly mitigates over-concentration risks. This hybrid strategy truly modernizes dividend investing, blending robust income with compelling growth. But remember, diligent research is your absolute best friend. Dive into fact sheets, analyze prospectuses. What are your thoughts on JPI QQQM? Share your insights and portfolio allocations in the comments. I love learning from our community. Found this tutorial helpful? Please hit that like button, subscribe for more content, and share. Absolutely ring the notification bell. In the description, you'll find official ETF fact sheets, white papers, financial planning links, and a template for tracking hypothetical portfolio performance. These actionable resources truly empower your investment journey. Finally, and crucially, this content is for educational purposes only, not financial advice. Investing involves risk. Past performance isn't future results. Before making any investment decisions, consult a qualified, independent financial advisor who can assess your unique situation, risk tolerance, and objectives. Personalized advice is always invaluable.